picture a bank vault, right? We have spent decades building retinal scanners and laser grids and, these complex digital firewalls just to keep the imposters out.
Yeah. And for our entire modern era, that is exactly how we thought about financial security.
Right. We built these massive, intricate systems to keep the bad guys outside the perimeter. But what if you pull up the security footage and you realize the person emptying the vault didn't break in at all?
Like they didn't even try to pick a lock.
Exactly. They didn't pick a lock, they didn't steal anyone's identity, and they aren't wearing a mask. What if the person walking out with the money is, like, on the VIP list, and they are exactly who they say they are?
Well, it completely flips the traditional security model on its head. I mean, we are looking at a phenomenon where the threat isn't coming from some shadowy hacker operating out of a basement,
Yeah.
half a world away.
Right.
The threat is coming from inside the house.
It really is. And, welcome everyone. Today we are diving into a guide called The Deceptive Customer. And it turns out the biggest threat to the financial system might just be everyday people going rogue.
It's a pretty wild concept.
It is. We are exploring this dangerous, murky gray zone where genuine customers weaponize their own legitimate identities against businesses. And we'll see why the billion-dollar security systems that banks and merchants rely on are almost completely blind to it.
Yeah, and to understand why this is such a massive blind spot, we really have to look at how the financial industry has historically defined fraud.
Okay, let's unpack that.
So the obsession has always been what we call third-party fraud. That is your classic imposter scenario.
Like someone stealing your credit card.
Exactly. Someone steals your social security number, they buy your credit card details on the dark web, or, they counterfeit your login credentials. The defining characteristic is that a bad actor is pretending to be you.
Right. The bad guy is a third party. They're an outsider trying to trick the system into thinking they are the account holder.
Precisely. But the material we're analyzing today breaks down a totally different beast, which is first-party fraud.
Right. First party.
Yeah, this is a financial crime typology where a genuine customer, a real person, using their real name, their real address, and their real account, deliberately misrepresents information, or they abuse a product, or dishonestly dispute a legitimate transaction for their own financial gain.
Wow. So they're just lying.
Basically, yeah.
Yeah.
The offender isn't impersonating anyone at all. They're simply injecting deception into their own relationship with the bank or the merchant.
I love to think of this like a nightclub.
Oh, yeah?
Yeah, like
All right.
modern bank security is basically a nightclub focusing all of its resources on the bouncer standing at the front door. The bouncer is meticulously checking IDs with a flashlight, making sure nobody's using a fake ID, maybe even checking fingerprints.
Right, they're looking for any sign of a fake.
Exactly. They are fantastic at keeping imposters out. But first-party fraud is the person who genuinely belongs on the VIP list. They show their real ID, the bouncer smiles and waves them through, they walk right in, sit down at a table, and then they intentionally trash the place.
That is a perfect analogy, because if the identity is real and the person standing in the club is supposed to be there, how do banks even begin to spot the crime?
Right. Like, where do you even start?
Well, what's fascinating here is that the core risk has entirely shifted. It is no longer a question of identity validity. It is a question of behavioral intent.
Intent. Okay.
Yeah. Traditional fraud controls are heavily weighted toward authentication and onboarding. They ask, do the biometrics match? Does the device fingerprint match? Is the IP address coming from the customer's usual home Wi-Fi?
And in first-party fraud, the answer to all of those technical questions is a resounding yes.
Exactly. First-party fraud isn't a failure of authentication. It's an abuse of trust.
Because the customer bypassed the bouncer legitimately.
Right. The deception happens later from the inside.
Mhm.
And this transforms first-party fraud from what banks used to think of as just a narrow debt collection problem.
Like someone just not paying their bills.
Yeah, exactly. It transforms it into a massive strategic control risk that affects credit underwriting, transaction monitoring, and overall financial crime governance.
So let's follow a deceptive customer from the moment they walk through that digital front door, just to see how this actually plays out for you or me. The very first thing they do is apply for something, right?
Right, the application stage.
Yeah, maybe it's a loan or a credit card. They are a real person, but they falsify their income, they lie about their employment status, or they completely misrepresent what they intend to use the funds for.
They're inducing the institution to provide credit based on a total fiction.
Right.
And the industry calls that first-party lending fraud. You are legally who you say you are, but your financial profile is a mirage.
Okay, let's unpack this for a second. Let's move to the next phase, where the customer actually starts using the account.
The account usage phase.
Right. Say they deliberately exploit an overdraft facility, or they use a buy now, pay later service to get a $1,000 television, knowing full well they're going to cancel their debit card after the first $20 installment.
Which happens a lot, by the way.
I bet. Or maybe they abuse a promotional incentive. But wait, is that actually financial crime? Or is that just a customer being opportunistic with a company's poorly designed rules? I mean, people default on debts all the time because they just, run out of money.
Well, it's a critical distinction, and it all comes down to intent. Intent acts like a Trojan horse here.
How so?
The bank invites the customer in because the exterior looks perfectly legitimate, but the damage is pre-programmed from the inside. Like, a genuine customer might default on a buy now, pay later plan because they lost their job.
Right, or they had a sudden medical emergency.
Exactly. That is hardship. That's a credit loss, not a crime. But the defining line for first-party fraud is the dishonest intent to gain financially from the very beginning.
So the timeline matters, like what they were thinking when they clicked buy.
Absolutely. If you incur a debt that you never at any point intended to honor, that conduct is fraudulent in substance. It does not matter that the transaction was technically authorized by you at the checkout screen.
Wow. Okay.
Yeah, it is a family of deceptive behaviors, all rooted in exploiting a legitimate relationship.
That makes a lot of sense. The intent is what turns a transaction into a trap. And that leads us to what happens after the purchase. The customer has the goods, the $1,000 TV is mounted on their wall, and then they strike.
The post-purchase phase. This is where it gets really messy.
Right. They initiate abusive chargebacks. They falsely claim a package never arrived, even though they're literally wearing the shoes they ordered.
Yeah.
Or they contact their bank to dispute a transaction, claiming it was unauthorized, when in reality, they made the purchase themselves.
And this is where the lines get incredibly blurry. Because sometimes the customer themselves might not even realize what they're doing.
Wait, really? How do you accidentally commit fraud?
Well, this is a concept known as friendly fraud. And it's a fascinating, deeply messy subset of this whole issue. It happens when a genuine cardholder disputes a valid purchase, but the motivation isn't a premeditated criminal scheme.
Right. If you look at how payment networks handle this, they break it down into a few really messy categories.
Yeah.
There's transaction confusion, right, where a legitimate charge simply looks weird on a bank statement.
Oh, that happens all the time.
Yeah, like you buy a coffee at a local cafe, but the charge shows up on your app under the legal holding company name, like Global Enterprises LLC.
Right, and you have no idea what that is.
Exactly. You don't recognize it, you panic thinking a hacker got your card, and you just hit the dispute button.
Exactly. Then you have household misuse. This is where a family member uses a stored credit card without the primary cardholder's explicit knowledge.
Yo, the classic kid with an iPad scenario.
Yes. It creates a contested transaction that isn't classic third-party fraud because a hacker didn't steal the card, but it isn't a straightforward criminal chargeback by the cardholder either.
Wait, let me push back on that.
Sure.
If my kid takes my iPad, guesses my password, and secretly buys $200 worth of video game currency, and I see that charge and dispute it, I genuinely didn't make that purchase.
Right? You didn't.
It's not my fault, so why should the bank treat me with suspicion for disputing that? I'm just a frustrated parent trying to get my money back from a mistake.
Well, this raises an important question for financial institutions, which is, how do they know you're telling the truth?
I mean, I just tell them.
But think about what the bank sees on their computer screen. They don't see a frustrated parent or a mischievous kid. They see a transaction originating from your exact device, using your exact IP address, authorized by your exact biometric Face ID or passcode,
Oh, wow.
and delivering digital goods to your exact account. All the data points directly to you.
Okay, so from their perspective, the biometrics are perfect.
Exactly. So for firms, that ambiguity creates an immense evidential burden. They have to prove your intent. They have to look at that $200 video game charge and figure out if you were a confused parent or if you were a deceptive customer who bought the games, played them all weekend, and is now lying to get a free ride.
So if intent is the deciding factor, that puts banks in a terrible position when the customer genuinely makes a mistake. The line between deliberate fraud and human error gets incredibly messy.
It goes.
And the stakes for getting that wrong are huge. Like, if the bank assumes I'm a criminal, they might close my accounts, ruin my credit, and just treat me like a pariah.
And that creates massive reputational and conduct risk for the business. You anger genuine customers and you damage your brand.
Obviously.
But on the flip side, overly passive treatment normalizes the abuse. If the bank just refunds every single dispute without asking questions because they're afraid of bad PR, they become a massive target.
Oh, people would definitely take advantage of that.
Word spreads on social media that this specific bank is an easy mark, and suddenly the losses skyrocket.
And because distinguishing between a confused parent and a deceptive fraudster is so incredibly difficult, these crimes get misclassified all the time. They just get hidden in plain sight.
Yeah, that's a huge issue.
Because the identity of the customer is genuine, these losses rarely get labeled as fraud. Instead, they get written off as credit loss or bad debt, or they simply get absorbed by the customer service department as the cost of doing business.
Yes, and that systemic misclassification is arguably the most dangerous part of this entire phenomenon.
Here's where it gets really interesting, though. If you're listening and wondering why a multi-billion-dollar bank writing off a few thousand fake chargebacks to keep their call wait times down affects your wallet, let's look at the ripple effect.
It's a big ripple.
Right, because it's their money, right? They are a huge corporation. How does a bank absorbing these losses actually impact the rest of us?
Well, if we connect this to the bigger picture, the externalization of that loss is staggering. When financial firms treat this as noise, instead of a material control issue, they underinvest in controls.
They just ignore it.
Yeah, they don't accurately measure the risk.
Mm-hmm.
And when banks lose money to fraud, they don't just shrug and take the hit. They pass those costs right on to the consumer.
Through fees and stuff.
Exactly. They charge higher interest rates, they reduce credit limits for honest customers, they inflate the cost of borrowing across the board.
And it doesn't just stop at the banks. They push those losses directly onto everyday merchants, too.
Oh, absolutely.
If you run a small online business selling custom furniture and a customer commits first-party dispute fraud against you, saying the table never arrived when it actually did, you lose the physical product, you lose the revenue, and the payment network actually hits you with a chargeback fee on top of it.
It acts as a hidden tax on the entire economy. Prices go up for everyone because businesses have to price in the expectation that a certain percentage of their own customers are going to rob them.
That's so depressing.
It is, but it goes even deeper than consumer pricing. The guide highlights how first-party fraud actively intersects with wider, much darker financial crimes. It is basically a gateway behavior.
Wait, how so? If someone is just trying to get a free pair of shoes by lying to customer service, how does that connect to organized crime?
Well, once a customer proves they are willing to burn their relationship with their bank for a few $100s in false chargebacks, they become the perfect recruit for money laundering networks.
Oh, wow. I didn't even think of that.
Yeah. Criminal syndicates need money mules, people who will let illicit funds pass through their accounts. And these syndicates know that a customer who commits first-party fraud already has a verified established account with a history.
Which makes it look legitimate to the bank's monitoring systems.
Exactly. And more importantly, that customer has already demonstrated they have zero moral qualms about deceiving their financial institution.
Oh, that makes perfect sense. The criminals need accounts that look seasoned.
Right. Seasoned accounts are gold.
Because if you just opened an account yesterday and suddenly $100,000 drops in, the bank flags it instantly. But if you've had the account for 5 years, even if you've been doing a little low-level chargeback fraud, the account itself looks valid. It's a perfect vehicle.
Exactly. A customer who commits first-party lending fraud to get a loan they won't repay might later use that same account for suspicious fund movements. We see heavy overlaps with collusive behavior and money laundering.
So it's all connected.
Very much so. It isn't just a narrow consumer credit problem. It requires coordinated action across fraud, anti-money laundering, and payments teams.
So having established the massive scale of this, how it hides within the legitimate ecosystem, and how it literally funds organized crime, how do businesses actually fight back against an invisible threat?
That is the million-dollar question.
Right, because we know the bouncer at the nightclub isn't working since the fraudsters are already on the VIP list.
Well, the solution requires a fundamental shift in the mechanics of monitoring. We have to move away from binary identity checks, asking, is this the real person, and move toward plausibility and behavioral checks.
Let's break that down. Say a new customer is onboarding. It's no longer enough to just check if the ID is real.
No, not at all.
Now, banks have to ask, do the declared income, the employment, and the product requested actually make sense together?
Right. The context matters.
Like if a 20-year-old student with a part-time job applies for a massive commercial business loan, the identity might be perfectly real, but the context lacks plausibility.
Exactly. Plausibility is the new perimeter. And then you move into the monitoring phase. Instead of just checking if the login credentials match, banks now build a mathematical behavioral baseline.
So they're watching how you act.
Yes, they are looking for patterns that indicate abuse. For example, they look for rapid balance buildups followed by immediate non-payment, or they look at dispute velocity.
Right. If you dispute one charge a year because your card was skimmed at a gas station, you are probably a normal customer.
Very normal, yeah.
But if you typically buy coffee locally and then suddenly you dispute 15 different transactions from merchants you've historically frequented, the algorithm flags the mathematical improbability of that sudden shift.
Exactly. It's evaluating probability, not just identity.
But how do companies test for this probability without acting like interrogators?
It's definitely a tightrope walk.
Because this is why the next time you go to dispute a genuine mistake on your credit card, you might face a lot more friction. How do banks implement these checks without ruining the experience for genuine customers who just want to get a legitimate refund?
That is the tightrope walk of modern banking, for sure. A mature control framework doesn't interrogate you at the checkout line. It uses complex back-end data analytics to spot these patterns quietly.
Behind the scenes.
Right. For instance, they map dispute frequencies against specific acquisition routes. They want to see if certain marketing channels, maybe an aggressive social media ad campaign for a buy now, pay later promo, are bringing in unusually high numbers of abusive customers.
Oh, so they're looking at the origin point of the bad behavior, not just the behavior itself.
Precisely. The goal is proportionate investigation. They want to preserve a smooth, frictionless experience for honest conduct, but have the data ready to challenge dishonest conduct.
That makes a lot of sense.
And a big part of that is fixing the friendly fraud we talked about earlier. Remember the coffee shop example?
Oh, the Global Enterprises LLC billing descriptor.
Right. Banks and merchants are working together to enforce clear billing descriptors. If the charge simply says the name of the local coffee shop, you eliminate the transaction confusion entirely.
Because the customer recognizes the charge so they don't hit the dispute button.
Exactly. It clears away the innocent mistakes so the algorithms can focus purely on the intentional deception.
That's really smart.
And furthermore, this requires robust internal governance. First-party fraud must be explicitly added to a firm's fraud taxonomies, their product risk assessments, and their collection strategies. If you don't name the exact problem and measure its mechanics, you simply cannot govern it.
So, what does this all mean for us? If we step back and look at everything we've unpacked today, the entire paradigm of security has completely shifted.
It really has.
It is no longer enough for a system to prove who you are. It now has to prove how honest you are. The bouncer at the door doesn't matter if the VIP is the one tearing up the club.
Nope. The bouncer's useless then.
Understanding this means understanding why getting a refund or disputing a charge or opening a new line of credit might require a little more friction and a little more evidence today than it did 5 years ago. Businesses aren't just trying to keep the hackers out anymore. They are trying to figure out if they can trust the person holding the account.
And as the technology gets better at proving identity, the pressure on behavioral analysis is only going to increase.
Absolutely.
The evidential burden we discussed, separating the confused parent from the active fraudster, is going to become the defining challenge for risk management in the next decade.
Which leaves us with a final, somewhat unsettling thought to ponder.
What's that?
Think about where technology is heading. As we move into a future where advanced biometric technology, facial recognition, and AI make it virtually impossible for someone to steal your identity, traditional third-party fraud, the classic imposter, might actually disappear completely.
Because it'll be impossible to pretend to be someone else.
Right. Which means, one day soon, first-party fraud won't just be a gray area. It might be the only kind of financial fraud left.
Wow.
Are we ready for an economy where the only criminals businesses have to fear are their own customers?
That is a terrifying thought.
It really is. Something to think about the next time you tap your card. Thank you so much for joining us on this deep dive. Keep questioning the systems around you, and we'll catch you next time.